Hello everyone, this is Germanos from Alliance Accounting. Today we're going to be giving a few more tips away. Our tips today are in relation to property and accumulating wealth through property. And we'll bring in a few things in regards to tax that will help you grow your property portfolio a lot quicker. Now, everything we do say is our opinion only. We don't expect you to act or rely on this advice, and we ask you to seek professional advice if you do decide to act on any information. My name is Germanos, and I've been in the accounting industry for a decade now. I've been helping investors and businesses grow their wealth and their portfolio. The way we do that is by providing quality work, hands-on work, and a great service where our clients call us anytime they wish to ask any questions. We're basically their partners when it comes to business and investment. Now, about property, of course you've probably heard about negative gearing. Negative gearing is a fantastic way to get into property. It is great in that you're able to reduce your tax, you're able to reduce your tax money to help fund the property. Now, one thing though is that I've seen people negatively gear their properties to a large extent, to the point where the money that they're paying to keep the property is so big that they really can't afford it. There's ways that you can negatively gear a property without necessarily paying any money. So those ways include non-cash expenses that you can put on your tax return. So a few of those might include, for example, depreciation, capital works and borrowing costs. So what depreciation is that a quantity surveyor will come into the property, will assess the value of items in the property, such as fixtures and fittings, the carpets and what have you, put a value on them, and then determine how long those assets are valid for, and then advise you on the tax deduction that you can actually receive. Now, a key thing is ensure that a quantity surveyor is a registered tax agent, because by providing you that advice, that tax deduction amount, they're actually giving tax advice, and they're now required to be registered tax agents. Borrowing costs is another thing that comes with your loan. We'll be giving more tips away in the coming weeks regarding these items, so stay tuned in. But having said that, by having depreciation, borrowing costs and other non-cash expenses, what you're effectively doing is you're increasing the amount of expenses on your property. Now, if you were to have a cash flow positive or a cash neutral property with these non-cash expenses, that will provide you a negatively geared property without you having to pay out of your pocket. Now, what do I mean by cash flow positive or cash flow neutral? What I mean by that is that the dollar amount you pay out for owning that property does not exceed the dollar amount that you receive back in terms of rental income and what have you. So that's something to keep in mind. Now, that's a key thing to think about in terms of accumulating future wealth. So remember this, you want a cash flow neutral or cash flow positive property, but a tax negatively geared property so that you can make the most out of your tax deductions. Now, why do we recommend cash flow neutral or cash flow geared or cash flow positive? Now, why we recommend that is the most difficult thing that people find in getting a property is trying to accumulate money for the deposit. That is what gets people stumped, having enough money for the deposit. Now, if your property is cash flow positive or cash flow neutral, it's basically paying off itself. Give it some time. If it isn't paying off itself, give it some time. The rent will increase to hopefully start getting it to cash flow positive, cash flow neutral, or you can pay off the loan or pay off certain expenses to bring it to that point. Now, by having it at cash flow neutral, cash flow positive, it's paying off itself. You're then able to put your salary or wages or your income into accumulating further money for the deposit of the next property. Now, by doing that, you can accumulate property faster. So, for example, I've had clients who have had properties where they're spending $10,000 to $15,000 out of their pocket to keep that property, in the intention, with the hope of keeping it negatively geared. Now, we've worked out a strategy to bring them down, make sure that they are cash flow neutral, so that they're not wasting money, because by spending $10,000 to $15,000 on this property, they're unfortunately losing around about $50,000 to $75,000 over the next 5 years. They could have used that money as a deposit on their next house. Now, if you concentrate on a cash flow positive property, you save up your deposit. Depending on how good and how keen you are as an investor, people can have a deposit saved up within 3 years. So you save up your deposit for the next house, you then buy that next house, you get it to the point where it is cash flow positive, cash flow neutral, you've then got two properties looking after themselves, you're getting a tax refund because they're hopefully negatively geared because you've got a good accountant, such as myself from Alliance Accounting, and then what you do then is, again, try to accumulate the deposit for the next one. Now, if they're cash flow positive, the previous two properties, what would be happening is you would be using the positive money from those first two properties to assist you in accumulating deposit for the third one and the fourth one. So effectively, your first one's probably the most difficult because you have to accumulate your deposit from your own salary and wages, then you have to accumulate, then you have to pay it off or get it to a point where it is cash flow positive. Your second one's probably a bit easier, you've had a bit more experience. Your third and fourth should be a lot easier because if the first two are cash flow positive, you're then using that money to buy your third and fourth property. That's our tip for today. We hope you've enjoyed our tip. We've seen clients who have gone from no properties to 5 or 6 properties in a period of 8 to 10 years. It is possible. These guys aren't millionaires, they're not rich. They're on, for example, $70,000 salaries. They just have their mind straight, they've got a good strategy, they've got a good accountant, and basically you can basically do that if you put your mind to it. So that's Germanos from Alliance Accounting. Please subscribe to our videos on YouTube, search Alliance Accounting, and if you enjoyed this tip, please let us know. Thank you.